my motto for 2025 is bonds tank until stocks do. That's my shorthand expression. Now, I don't mean tank. Let's say bonds leak till stocks tank. How's that?
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest has long warned that the bond market will one day take the printing press away from the Federal Reserve. Well, the Fed has now cut its policy rate by 100 basis points since September, but the yield on the 10-year US Treasury note is now 100 basis points higher since then. This has flummoxed many investors and mortgage holders, yet it begs the question, is this the start of a bond market revolt against the Fed? To find out, we're fortunate to welcome back to the program analyst Bill Fleckenstein of Fleckenstein Capital. Bill, thanks so much for joining us today.
Well, thanks for having me back, Adam.
All right, Bill, Happy New Year. It's going to be an interesting year. Would love to get your thoughts in general about what you think is likely to unfold over the new year here. But to kick things off, let me just start this with a question I like to ask you at the beginning of these interviews. What's your current assessment of the global economy and financial markets?
Well, I think that the global economy is going to stay kind of the way it's been, which is not all that great, although not terrible. The size of the fiscal deficit the budget deficit we have here is huge, and that has helped our economy. It's sort of created these what I like to think of as kind of stagflationary conditions, where we've got a high rate of inflation relative to the underlying real rate, and of course we have all the price increases we've absorbed up to this point. And meanwhile, there's no real powerful driver of growth, and in the rest of the world, there's nothing really to get excited about. Maybe China's policies are going to work if that's what they want, and who knows exactly what their agenda is and whether they can accomplish it. But I mean, Europe's continues to be the way it is, which is limping along for quite some time now. Of course, it appears that perhaps they're going to have some political turmoil there. But I don't think there's anything to get excited about on the economic front. I think that the prospect of pro-capitalist free market types of policies that Trump wants to pursue and will talk about has gotten people's expectations up and have gotten them excited. But I think delivering on them, which we don't know exactly what they are yet, is going to be a bigger problem maybe than some people think. I'd like to be wrong, because I'd like the best things that can happen to the country happen. But if you look at the construction of the budget or with the big spending buckets, without a willingness to tackle social programs, and if you look at what's can be addressed, I would think that if Musk and the Doge team, Vivek, could come up with $500 or $600 billion in cuts, that would be heroic. It would be a big deal, but it wouldn't really move the needle in terms of the problem of $1.5 trillion budget deficit and the overall size of the debt and sort of the compounding that is occurring thanks to the interest on the debt. I think, unfortunately, we're probably, if they'd come up with Doge in 2016, maybe we would be in an entirely different place right now.
Mm-hmm.
But the extra, pick a number, what is it? 10 trillion or so that we've gotten added to the debt in the last 8 years or so. I think we're kind of past the point of no way to get past it without some real pain. Now maybe I'll be wrong about that, but that's the way it looks to me.
Okay. Well, I want to dig into that with you in some depth here. I've had this discussion with many people recently on this program, Bill, and was going to ask you this question, but you've now already answered it, which is, has the enthusiasm for the new administration's economic policies maybe outstripped those policies' ability to deliver the benefits on the timeline that folks are currently hoping for? And it seems like you're thinking, there's probably going to be some disappointment in there.
I think so. Now, there may be more excitement before there's disappointment, though. It's hard to say, right?
Mm-hmm.
Thinking about how great it's all going to be is a lot easier to do than actually, creating the policies and getting your people appointed, if they can even get them appointed. And people act like the Trump slash Republicans, although I don't really consider Republicans and Trump to be all on the same side. They don't really have much control of Congress, because there's so many people in the Republican Party that will vote against things that Trump wants, even his appointments, right? I mean, I see Lindsey Graham out championing against Robert Kennedy. Now, how can you be against Robert Kennedy, given what we've seen that has gone on in the healthcare system and all that? I mean, but some of these politicians are so worthless. Anyway, on both sides of the aisle. I see nothing but complications and roadblocks. Now, I'd like to be surprised about that, but by definition, I'm surprised it's something that I can't see right now.
Right, right. But to a certain extent, do you feel that the Trump entering office will perhaps prove to be sort of a buy the rumor, sell the news type of event where everyone's super excited, but eventually they're going to realize once he's there, hey, the swamp hasn't been drained yet. There's a lot of this political morass that's going to still, the hacking through it's going to take a lot longer than maybe we got our hopes up, that type of
Yeah,
thing.
I think for sure the implementation will take longer and be more liable to have 2 steps forward, a step and a half back, all that sort of thing. If you compare this to Reagan in 1980, they slashed tax rates as well, and the deficit was, I think, maybe 30 or 35% of GDP then. So as opposed to 100 and some percent, 120% or whatever it is now. Of course, that doesn't count all the unfunded liabilities that are
Right.
that are much nearer to coming into existence than they were, 10, 20, 30 years ago. Of course, then Volcker was in the process of trying to break the back of inflation, which he did. So rates were jacked up. So you did have rates going the wrong way, although for a good reason, which put us into the first recession of the 1980 recession, 80, 81.
Right. But
And
you're able to ride the decline of those rates to
yeah,
goose the economy. Yeah.
yeah,
Yeah.
that was after 82, 3, 4. But the first year and a half was pretty messy. So again, there was higher rates. Rates were not 5, they were 13, 14, 15, 16 on the long end. But we did have big tax cuts coming there. So anyway, if you use that as a template, you can kind of see how it would be easy to get excited and then be disappointed. So
Yeah. Yeah. And I think it's very important. You just mentioned those conditions, the difference in the conditions. But even that aside, and I've asked this question a lot. I mean, let's assume that Trump is successful, right? By the end of his 4 years, he has negotiated better trade deals for America through at least the threat of tariffs, if not their implementation. He has gutted government bureaucracy, and he has deported millions of people. Every one of those three things is disruptive and will create some short-term pain to get to the long-term benefit, right?
yeah, I would expect so, yes. And again, those are all pretty vague, right? If
Right.
what's the success? What's a number you would consider success for cutting fat out of the budget? $500 billion. Well, when you look at the components of defense and all these other things, $500 billion would be a big deal, but it's not a big enough deal to move the needle.
Right.
You know, here's what they have to accomplish. They have to be able to try to do what they're trying to do and try to grow their way out or inflate their way out without the bond market going in the tank. So basically, if Trump were king, which he probably wouldn't mind being, and he could say, okay, we're freezing interest rates where they are, and we're going to grow, and if they could keep the bond market from moving from where it is to higher rates, then maybe they could pull this off. They could get 4 or 5 years worth of growth and get GDP moved up to get the ratios in line. But the problem is, I don't think the bond market's going to sit still while they try to do this, because part of the reason why the curve is the way it is has been the confidence in the Fed, which has, of course, been misplaced, but nevertheless, it's been there for a long time. And of course, Janet playing footsie with the stock market in the last group of years by doing all the financing at the short end to try to keep things ginned up, right? Well, now there's a lot of debt to roll, and maybe they can do it all at the short end still. At some point, they're going to need to term it out. My premise is the bond market is not going to tolerate what's coming in terms of growth initiatives and the inflation that's already there. Now, maybe people will conclude that it'll be the perfect mix of cuts, which will create an undertow for the economy, and then they can stimulate and there won't be inflation. And maybe you can try to concoct a story about a big, long, sweet spot where everything will work out just great while we go through this. I don't see how that happens, but it's theoretically possible. And it's also theoretic. It also has the benefit of, remember, the passive bid, which makes stocks go up every day that ends in Y, that's not a weekend day. And so it may look like the stock market believes or is discounting good news, and people may get fooled. But the stock market going up is a function of one thing. Vanguard and BlackRock have money that they got from their 401k and all the target date funds, and therefore they buy, right? So trying to use the markets as an indicator of how likely this may be to work, and having the market discount things, we don't really have that tool at our fingertips, because the stock market as a tool for prognostication has been broken by the passive lunacy that is only getting bigger by the quarter.
Okay. So obviously I want to talk with you about that too. But let's stay on bonds for a moment here. So one of the reasons why I reached out to you to do this interview, Bill, was a little exchange that we had on Twitter a few weeks back, and this was after the latest Fed rate cut, and yet the Fed, cut rates, but then bond yields continued to increase, right? And I pinged you and basically said, hey, I know that this is sort of what you've been warning about, Bill. Is this kind of game on now for the bond market starting to take the printing press away from the Fed? Here's what you said. You said the bond market has tanked ever since the prior cut. It's still only been a few months, but this is exactly what it looks like when the bond market takes away the printing press. We can't say for sure that it's happened, but we should think that it may have and behave accordingly. So for a guy who's sort of been waiting for this playbook to start to play out, right, where the Fed does one thing and the bond market does the other, what's your level of concern at this point that, like, okay, yeah, the bond market really is starting to part ways with the Fed?
Well, I think that it's really not debatable that it's been 3 months now that since the Fed started cutting rates. Now we cut rates. So if you'd have said to me ahead of time, Bill, what will it look like when the bond market starts to take away the printing press? I would have said, well, what'll happen is the Fed will cut rates, and everything from, pick a number, 7 years out, we'll see rates rise, even though short rates have fallen, i.e. the curve will get steeper. That's what I would have said.
Okay,
I probably
so
did say that.
check mark. We have that check mark now, yeah.
Now, if it goes on for a month or two, you could say it was just noise and maybe too many people had discounted the cut and got too excited. But it's gone on quite a while now. I mean, obviously, 3-4 months is not a huge amount of time. But I would guess if we're sitting here in March, it'll still be the same. maybe the long rates will have bounced around 25, 30 basis points, but I don't think there's going to be any relief. I mean, I think this steepening is, you know, is reality. The bond market steepened itself because it doesn't trust these policies, and it doesn't trust therefore it doesn't trust the Fed. I mean, to think that the Fed has been cutting 100 basis points, I just can't even get my head around how they could talk themselves into that. On the other hand, I don't, they've made, I don't, maybe out of every meeting they've had since 1995 or six, the first few years they weren't too bad, even though Greenspan got drunk on productivity and believing in all the, all the things hedonics were supposed to deliver. But since they aired after their attempt to get things rolling after the stock bubble blew up, almost every decision they've made, every decision they've made to ease has been wrong. Obviously, in 08, they had to do something. But again, they were never called on the rug for their role in the monetary policies that led to the bubble. They're cheerleading for the real estate market, saying it couldn't have a bubble specifically because real estate was not arbitrageable. That was Greenspan's argument. And then they had the regulatory oversight for the banking system that they got when Greenspan helped lobby to get rid of Glass-Steagall. So every single thing that they could have done wrong in that period, they did wrong. Then they came back with QE, which was going to be a breeze to get rid of. Remember, Bernanke says, well, we'll get rid of it and we can stop inflation. They made up all these things they said that were not true. So for them to finally lose credibility is well-deserved. I mean, I think Powell's done a horrible job. I mean, the way they rationalize their easing in COVID, not so much that they did that, but then their belief that the inflation would be transitory, and by transitory they meant like kind of a blip, not like a jump a mile high and then we'll go sideways for a while, and because it goes sideways and not going up anymore, then it was transitory, but the size of the hike was bigger than your house in prices. So these guys are just horrible. And so the fact that he's been cutting here, and the fact the bond market doesn't believe him, appears not to believe him, I think makes sense. Now, maybe sometime between now and March, and we get the Doge thing going and people get all excited, maybe the bond market can have a rally. But absent a rally that occurs because people get mistakenly excited about how easy it is to trim costs, the only way you're going to get a rally in the bond market, in my opinion, of any consequence, is if stocks crack. And I mean crack hard, where they break 10, 12, 15%, something like that, to scare people.
So you mean bonds benefit as a safety trade in that environment, is what you're saying?
Yeah, or not so much a safety trade. I mean, partly that, because that's a knee-jerk thing that people do, but partly, well, the stock market cracks, obviously it'll be saying something about the passive bid, which says something about employment. And if employment weakens, then you could see the economy weakening, even with the 6% budget deficit, goosing GDP and the wealth effect from people that have money. But I think that the bond market needs a stock market break to get any kind of help, and even that'll just be temporary, I think.
Okay, so you're saying, look, the stock market is broken as a signaling mechanism because of the passive flows.
Has been for quite some time.
Has been for quite some time, and we're going to talk more about that in a second. So you're like, all right, stock market's not sending us accurate signals. Sounds like you think the bond market is sending us accurate signals, saying that it's getting worried, and it's getting so worried that it's now heading in the opposite direction of where the Fed wants it to go. I'm just curious, Bill. So totally get the explanation you just gave on why it gives you confidence the bond market's beginning to buck here. You've been an investor for a long time. Do you talk to active bond investors? Like, are you hearing from the people that are actually buying bonds that?
No, I have one friend who's a really talented bond manager. I can't say his name because he likes his privacy. I mean, he's more sanguine, at least about the inflation side of things, than I am. And I guess if you thought that inflation was going to melt away to zero, then maybe you could figure out how we could get through this period that I discussed where the bond market's going to have, they're going to have trouble keeping the bond market from backing up. If you could get people to think inflation was going to magically disappear, then maybe you could do all this with rates, where they are to 50, 70, 100 basis point lower. I mean, to think we're ever going to see 3% handle on the long end of the treasury market again, I think is completely delusional, but we'll find out.
Okay. Um, just because you're opening yourself up to it with that statement, I do interview one or two folks that invest in bonds who do think that inflation will, I mean, not trend to zero, but we'll get to the Fed's target um, because of the debt overhang and slowing of the economy and all that stuff. And it might be fun to have you, on to
Well,
kind of
listen,
discuss with them.
I know that argument, obviously, and I've interviewed Lacey myself, and I have tremendous respect for him. And I mean, Lacey Hunt is one of the people that's making that argument, only he makes it very cogently. I don't mean to be any slightly disrespectful to him. Having said that, that argument didn't carry the day when we just went through the crazy patch of inflation that was precipitated a lot by all the stimulus that happened during COVID. But what people fail to understand, and I've been trying to make this point for a very long time, is the psychological component of how people perceive things affects their behavior, both economically and financially. And when that changes, it is very hard to get it back. And if you haven't seen that take place, it is difficult to understand that. I have tried to explain this to people often, especially as we talked about what would be the outcome from the NERP, ZERP insanity period we went through.
Yep.
And a lot of smart people would disagreed with me. And I think because they don't understand the human nature element when it comes to inflation and fixed income. People get it. People understand reflexivity with the stock market, right?
Hmm.
Soros wrote the book. People have thought about it. They can see it's happening. That's not really argued by anybody who's spent any serious amount of time around the markets. Well, there is a certain element to that as well. When you come to believe that inflation is going to be a problem, and particularly when you have to digest the big price hike we had, and then the current anniversarying of those dates is 1 to 4, and everyone's trying to say, see, inflation is not a problem. It was just like we said, it was trans. Those people lose credibility because the people that are suffering and say, well, yeah, you're saying inflation is not a problem, and they wouldn't articulate it this way, but what they're saying is just because the current change isn't a big number doesn't mean that I'm still not hurting from the net change of the last couple of years.
Right. Doesn't mean the prices still hurt and I can't afford the things that I need. Yeah, got it.
Yeah, just because the price of milk has gone sideways after doubling, I'm just making up an example.
Yep.
You're not going to be able to tell the person that has to buy the milk that there's no inflation. Now, you'd be correct to saying that the change has dropped to zero, but they're still experiencing the price hike. It didn't go away.
Hmm.
And once that psychology changes, it is very difficult to switch it the other way in both directions. So, for instance, in 1984, so the big stock market rally took off in 1982. Interest rates came down, and then by mid 84, people were afraid again that inflation was going to finally come roaring back. Milton Friedman was going around the cities making speeches about how we were going to have another wave of inflation. I was still pretty green. I'd only been in the business for 4 or 5 years then, but it seemed to me that we shouldn't. I didn't see why we would get more inflation. But that was the belief, and so what happened was bond rates backed up to 12 to 14%, even though the underlying rate of inflation I think was between 4 and 6, and on its way to being under control. So finally in 84, that was the end of the backup in rates. And from there on, rates declined for quite a long time irregularly. And we all know we had a 30 or 40-year bond bear market. But my point is, psychology finally went the other way. Okay, we trust the Fed. We're not worried about it. And therefore, in the next 20, 25 years, when the Fed would pursue policies at the margin that might have been mistakes from an inflationary generating standpoint, they got to pass. And so a lot of the inflation that we experienced, say from call it 96 or 7 to 2007, was didn't bother people because they didn't feel like there was any underlying huge inflation pressure. And the policies that were creating what inflation we had were also boosting financial assets.
Right.
So people are getting rich in stocks and houses. And so this small amount of CPI didn't matter. Anyway, now fast forward to all the abuses that have happened, QE and all that. Now, what I wanted to do was walk you through a period where I saw psychology changed. I witnessed it. I experienced it. And that's the thing that I think people tend not to appreciate, which is why I went into so much detail. I brought this up before several times. I think people's eyes mostly glazed over before it actually looked like it might matter as it does today. So sorry for that sidebar, trip down memory lane, but I think it's important that people understand this.
Yeah, well, I mean, look, it's based on the work of folks like Peter Atwater. He basically just looks at sentiment and confidence and says, there's a lot of other stuff to look at, but that's what really drives markets at the end of the day. All right, so on this part, I totally get people saying, hey, look, until I get the memo otherwise, I'm going to expect inflation's going to remain a problem, right? Just because I go into I try to live my life and everything's a lot more expensive than it was just a couple years ago. Folks still have that recent pain
Well,
in their
they're
memory.
still experiencing it, even if the current run rate of inflation doesn't seem too out of line relative to expectations. Like people expect 2.2 and it's 3.1. In the past, that wouldn't have mattered, but the fact that it matters now, people are still dealing with the huge price hikes that they had.
Yeah, and the consumer, they don't think about 2.7% difference. They just think of like affordable or unaffordable, right? And
Right,
life feels a lot more unaffordable to them
right,
now than it
right.
did just in the
Correct.
recent
Yes,
past,
yes,
right?
yes, yes.
Okay, so that mentality, until something changes to shift that, and really, I mean, look, let's speculate here. What could change current sentiment? Now, one could, on the positive side, could be an economic boom, right? And everybody's incomes start growing faster than the cost of living, and everybody, all of a sudden, world starts feeling affordable again, and everybody feels optimistic and they're willing to spend more. Now, obviously, I guess, we could flip into recession, which wouldn't be fun or welcome to most people, but that's something that could bring prices down because demand is going down. But if you lose your job in that process, you're not happy about it.
You haven't
Um,
gotten ahead, no.
yeah. Um, so I guess from a sentiment standpoint, are you just expecting more of the same going on from here, or do you expect there to be something that will eventually, is there something on your radar that you think is going to come and materially change market sentiment?
Not that I can see. I mean, we have known catalysts coming up, right? What we have the catalyst of what people will Trump be able to get into the positions he wants to get. What will they do? How fast will they act? Which policies will hit first? Which ones will make a difference first? And so I think all you can do is wait to see how they start to play out. But again, I mean, sure, let's say they waved a magic wand and they made oil $20. Well, that might allow them to get a couple years down the road with the bond market rally. That would help inflation expectations, people's expenses, and so I just came up with a thing that could happen that would kind of make give us this big sweet spot. Now I don't know how they're gonna. I'm not saying that's doable, but I think that's one of the reasons why I think in an interview Scott Bessent did not too long ago, one of the things I believe he said was, about how Trump wanted to really get, drilling going and boost energy production with the hope. I suspect that would be the rationale, right? You'd like to drive down something that's big and permeates a lot of prices.
Right.
Now, if they could do something like that, I don't know what other thing we could think of that would be a magic bullet, but perhaps they're out there.
Okay. Um, yeah. Well, all right. Let me ask you this then. Trying not to go down too many rabbit holes, but given that we know the people now that Trump has nominated for these key positions, what do you think about, what's your personal opinion on his selections so far, if these folks were to get approved?
Well, I am pretty
Dissent
favorably
and others, yeah.
exposed to most of them. I'm not to say I believe every thought that every one of them has, but net, they look like people that are serious about fixing things that look to me to be wrong, right? Cutting government waste is great. Why would we want an inefficient government? And why would we want people that behaved in a partisan fashion rather than doing their jobs, which is quite clear we've experienced that, right? Um, um, but I don't really see how any of them can look. Let's say you're a huge Bobby Kennedy fan. I like a lot of the things that he's had to say, and I think we need to clean out the rot at the CDC and the FDA and anyone who paid close attention to what they said during COVID and other things and how they handled a lot of this would likely be critical of them. And so cleaning out those organizations will be good for the country and good for everyone in it, but that doesn't affect the finances much,
Right.
right? That's not going to affect the problem. And so when you go down the list of, I mean, I don't know how you feel about the FBI, but I don't see how we're supposed to trust them. I mean, this rat Johnny Isaacson sick the FBI on my friend Mark Cahotis because he correctly identified the guy that Pete Pettit that was running my medics. It was a complete fraud. The guy went to jail, but they sicked the FBI on him. I mean, we've seen tons of stories. So I'm just saying that the people that he's picked that are serious about trying to rectify some of these problems that look to be quite serious and are for our daily lives, they don't move the needle on finance. So the problem is that Scott Bessent might be a great pick, but I don't know how he's going to wave a magic wand. He's the one that matters. The Doge matters. I've already talked about that.
Yeah.
That is good if you believe that he picked the perfect person for each position, which I'm sure no one believes that, and I'm not saying he did. Even if he did that, I don't know how that solves the size, their gargantuan size of the deficit. And you could have a perverse reaction in that the Doja guys come out and they find 5 or 6 or some big number, and it doesn't help the bond market that much. And then people start to pay attention to, well, why is the bond market acting so poorly? And they start looking at the fact that the size of the debt is kind of intractable. Now, if they can get some economic weakness, maybe they can get the Fed to do YCC, yield curve control, a
Yep.
la Japan. I mean, there are rabbits they can try to pull out of the hat, but then they got to get the market to go along with it. And most of those things require some kind of weakness or a big whack to inflation causing items. That's why I picked oil as an example. But when you go through what they could be, it's difficult to see how this is going to work
Okay.
in any kind of a painless way. Let's put it that
Got
way.
it. Got it. Okay. So in terms of the bond market, we have what looks like the bond market, like I said, separating from or losing faith in the central bank and taking matters into its own hands. In previous generations, they call this the bond vigilantes. So what do you see is most likely for the bond market over the next year? Do you see yields continuing to kind of drift higher as the bond market continues to sort of solidify its opinion of where things are headed? And obviously, I know, if something major happens, like they get the price of oil consistently under 20 or whatever, yes, that'll change the soup. But what you think is sort of more realistic? Do you expect yields to continue to creep higher than everybody wants, or do you see something different?
No, I think I think my motto for 2025 is bonds tank until stocks do. That's my
Okay.
shorthand expression. Now, I don't mean tank. Let's say bonds leak till stocks tank. How's that?
Okay.
So I think the pressure is going to be on higher rates. Now, maybe they get to a 5 handle on the 10 year and everyone decides, wow, that's just such a great number. And that's the ceiling or floor, depending on how you want to look at it for a while. I don't know. I'm just making it up. But like I say, we know we have catalysts coming up that are liable to be rather potent. And so to try to project exactly what they're going to be and how they're going to play out is rather difficult. I think you just kind of have to wait and see who gets approved, not just nominated, but approved, appointed, whatever you want to say it, and then what the policies are and how they collectively go together. My bias is I've shared with you that it's going to be difficult to make it work, but we'll have to see.
Okay, but don't worry. You did what every interviewer hopes for, is you intuited where I was going and kind of gave me the big answer early on, which is bonds leak until stocks tank. Okay, so you expect bonds to continue, bond prices to continue drifting down as yields go up, and then at some point, you think the stock market's going to crack. Let's now talk about that. And really what you think the triggers could be for stocks tanking. Is it the rising cost of capital, or is it something else that's out there? And we talked about the passive bid that the markets have. Something obviously would something need to change to the passive bid to enable the stock market correction, or could stocks correct even with the current passive dynamics?
That's over everyone's pay grade.
Okay.
That may be Mike Green's, and it might even be over his. Um, Look, it would appear that the only way the passive bid can kind of get swamped by the market is if the passive bid gets smaller, which is a function of employment. So I believe that I'm not putting words in Mike's mouth. I'm pretty sure I've heard him say this several times. We start to see unemployment rise or employment decline, then you're going to see a smaller amount of daily liquidity injections into the market from the passive complex. Now, I have a pet theory that I don't know if it's true, and I haven't had a chance to talk to Mike about it. But my thought was perhaps if we had a blow off thanks to the Fed cutting and the optimism about what the election would bring, perhaps you could push the market to a place where the overall market cap itself was at the margin too big for the passive bid to support. And if that were happening, you might see some of the things that we've seen, like I don't know the exact number. In December, there was a record number of days down in the Russell.
Right.
I think that the Dow had a 13-day losing streak or something like that for the first time since 1973. So you had the indices hitting the new highs, which was driven by the mega caps, which are the ones that the passive bid perversely distort the most.
Yep.
And so you could say that, well, maybe the market was kind of in the process of exhausting itself to the upside. We got speculation, especially when you throw in the levered ETFs and the single stocks all concentrated on the same group. Maybe you could put the thing up to a place where it could start to fall of its own weight. Now, like I said, that would be a conversation to hash out with Mike. And actually, Grant and I are going to talk to him in our Endgame podcast. Not to talk about a different podcast than yours, but
no, feel free and steal that question. I'd love to hear Mike's answer to it.
We're not competing with you in any sense, Adam. That's one of the things I want to flesh out with him. How does he think about that? And I think we're doing it sometime in the next couple of weeks, so I'll get an answer to the question. But that's kind of been my working thesis ever since the Fed indicated it was willing to think about cutting last March. I started worrying about a blow off in the equity market, and I started musing about, well, maybe we could push the market cap of the market up so high and the economy would be okay, but not strong enough from an employment standpoint. The passive bid wasn't big enough. You could start to crack the edifice without the passive bid going to zero, so to speak. So that's a pure theory on my part. It could be happening. I mean, so far the market's acted kind of funky for a new year and the tail end of last year. So you could argue in the same way
you could argue
that might be underway. In the same way that when rates first started up, when the Fed started cutting, you could argue that maybe something was changing. It might have been noise then, but it looks less like noise now for the bond market. And the same could be true for stocks. Maybe,
There's
maybe the bubble's exhausted itself, and maybe the passive bid's not big enough, and blah blah blah. So, but that's a pure theory on my part.
right, right. Well, things that would support it are we have cyclically adjusted PE ratios, what, at like 38 times now? Like, I mean, the only other time we've seen this happen before was, I think, in the dot-com excesses. Buffett indicator has never
Yeah,
been this high.
yeah. Valuations, we can slice them a bunch of different ways, are pretty absurd, especially for some of these mega cap companies. And we can see speculation is really off the charts. Now, some of it's going on in the crypto universe and other places, the single stock gambling that goes
ETFs,
on
yeah.
in the meme, all that kind of stuff. But that's a mindset. That's all a mindset. And so
Right. But
but
these are
but those
symptoms you would expect to see if your thesis were playing out.
no, no, no. Those are signs of excess. What you're talking about are signs of excess. What I'm talking about is something that's signaling that the status quo might be changing. See, wild speculation, all those things, those are just signs of excess. That doesn't mean anything's going to change. What I'm
Well,
talking about
I
is
guess where I was
that
taking it was if you were to think that evaluations would get ahead of them, so get ahead of the passive flows, you would
no, no,
probably expect
I'm
to
not talking
see
about
it heading.
valuation. I'm talking about the size of the market cap, the overall size. Remember, when you buy, when you buy a share of stock, you can move the price. That changes the valuation for the entire company. You only bought a few shares.
Right,
So what I'm
because
talking
there's
about,
price on the margin. Yeah.
yeah, what I'm talking about is the overall market cap for stocks in the aggregate.
Hmm.
But and the passive bid has helped keep them up. But it's worked its magic mostly in the mega cap arena, and that's
Hmm.
what's had the indices go up. But we've seen the signs of narrowness that we're discussing. That fact is a sign that the passive bid isn't big enough to drive up everything. It can take the stocks that it most easily distorts, and then you get momentum people in there, and you get a lot of speculation in there. So to me, those are the signs that this may be happening. Is the narrowness of the advance, and the only thing really doing well are the ones that are most distorted by the passive bid itself. Whereas where the passive bid doesn't really benefit, those areas have been weak.
Okay.
That's what I'm suggesting.
Okay. And that all makes sense to me. Let me ask you this. So I kind of hear you talking about two different tiers, right? One is the market cap gets too big for the passive inflows to support its size. And so you have a resizing, which you could say,
Yeah,
which I would say is sort of like correction number one, which is just right sizing the market cap to these passive inflows. But the passive inflows are still having a upward, support
correct,
structure to the
correct.
market. Then there's correction number two, which would likely be much bigger, would be, okay, what if those passive flows start declining, right? For
Right,
any of the reasons you mentioned
right.
earlier, but likely job losses, right?
Or if they rebalance for some reason. Now, I don't know the rebalance schemes, but I think Mike said that part of the reason 22 was as ugly as it was is because the bonds were, down every day. And at some point, the passive guys had to rebalance their target date funds. Now, what I don't know is that purely mechanical based on a date, or can they do it, or do they have to do it when it gets a certain amount out of whack? Again, that's a question for Mike. I don't know the answer.
Okay. Let me ask you this question related to it, though, which is, um, as you said, we have the market cap incredibly concentrated. I mean, unprecedentedly, I think, in
Mhm.
market history, in terms of market cap riding on just a very small number of stocks. I mean, essentially sort of 10-ish stocks, right?
Right,
Um, and we have everybody in the pool. So if you look at like percent long and institutional investors, they're at extremes. You look at percent retail investors in the market, those are at high levels. You look at the percent of seniors, their percentage equity exposure, it's at like all-time highs, right? So like everybody is in the pool riding on these 10 stocks. And then if you look at the US market's percent of total global market cap, it's at like an all-time high as well, right? That investors from around the world are coming into our markets
Right,
because it's the best game in town right now, right?
right.
So you kind of have everybody all in on this very small number of stocks, right?
Correct. Correct.
If those things go through a correction, can we even really imagine what the implications are going to be? I mean, it seems to me that like, the potential contagion from that is hugely underappreciated.
I would agree. And if that starts to cause some trouble, it might give bonds a bounce. That's the scenario you're talking about is what I was saying when bonds leak until stocks crack, right? And
Yeah.
so there's some signs that maybe stocks are starting to crack. And we'll see. And if they do, I think that'll help bonds out a little bit.
Okay. And I mean, we're speculating here, so I'm not going to hold you to any of this, but when you think of likely triggers of what's going to cause stocks to crack, is it more your thesis that just the market cap gets
Yes,
bigger than it
yes.
should? Okay.
That's the only thing.
That's the only thing. Okay. And let me just
Because
ask you.
because fundamentals don't matter to the passive bid, and they only kind of tendentially matter to the market at large. And so you need the mindless robot to be kind of like not in control of things. And if that happens, you'll have weakness. I think irrespective of the likely economic outcomes that we could see. Now, again, if something magical happens and it changes all the mix, that would make a difference. But in the absence of that, I don't. If the market wants to crack because the passive bid's not big enough anymore, there's gonna be quite an undertow, I would think.
Okay. Let me ask the question a little bit differently, and I think it's important for folks understanding to make sure we get what you're talking about here. So I hear you, which is, look, as long as the giant mindless robots in there buying, the status quo is going to continue unless the total market cap gets so big it exceeds what the passive flows can do. So until
Right.
there's a monkey wrench thrown in the robot's gears, expect the status quo to continue. Now, one might make the argument, okay, look, if the bond market continues to leak the way you think it will, that means yields are going up. That means cost of capital remains higher for longer, right? We have this, we're kind of getting into an important year for the corporate debt maturity wall, where companies are refinancing at now potentially substantially higher debt. So one might say, hey, that's going to, squeeze profit margins on these companies, and shouldn't that bring down, stock prices and things like that? I kind of hear you saying, no, I mean, not really, at least not in the aggregate because of the giant mindless robot. It would only if profit margins get squeezed to the point where companies start laying people off at big enough scale that those retirement inflows start
Right.
shrinking, and then
Yeah.
that is the robot buying
That
list.
that's the macro level. At the company specific level, if the market is kind of say wounded or the passive bid is wounded vis-a-vis the size of the overall market's total market cap, then you might get into a situation where individual stocks could get hit hard. Now you've seen a lot of that. I mean, there's been, some of the popular stocks even have been hit hard, but then they've come back, right?
Mhm.
But I mean, look, Apple's earnings are about flat for the last couple of years, and it's 30 something times earnings, the biggest market cap. It's now not, it's not really debatable. They don't have anything innovative. I mean, why does it sell where it sells? Now, maybe if they have a bad quarter, instead of laughing it off and driving the stock price higher, as investors have done, maybe they'll tag it, and maybe individually some of these things that have held up, sorry, that have helped drive the market higher thanks to the passive guys, maybe they'll actually be able to go down in some kind of size that'll scare people. So I think fundamentals can matter in specific cases, like when they report. You know what I mean? But
Mhm.
in terms of fundamentals, in terms of the market discounting problems and starting to impute it into prices, that part doesn't really happen. If they're gonna tank, they usually do it on the numbers, right? And then they go off a cliff or they go up straight up, depending on what it is. But so I don't mean to say fundamentals don't matter at all. I think macro fundamentals don't matter much, and we might be getting to a situation where bad news could actually be bad news. Usually when the Fed's easing, that's not the case. But we don't usually have the Fed easing and the bond market going the other direction either.
Got it. Okay. All right. So beginning to wrap it up here. So if bonds leak until stocks tank, what odds do you give the stock market of making it through 2025 without hitting the tanking moment?
I would say probably zero.
Okay. So you expect a repricing in the equity markets this year. It's fair to say.
Yeah, yeah. I mean, I think there'll be at a minimum a scare to the downside. Whether we finish down a whole bunch over the course of the year, I don't know. We have to see how things play out. But I would say that the chances of that happening are extremely high. Sorry, the chance of a decent sized decline are very high. I think there's no chance we get away without some sort of downside scare. Whether we finish down the year or not, I don't know. I mean, too many things have to play out. I mean, how can you predict what's going to happen at the end of the year? We got to see how things start to go and how people respond to what happens. But I think the pressure is certainly there to cause that to happen.
Okay. And what do you think of the reaction function of the central planners will be under a Trump administration? Any different than they've been previously?
Well, I think it's pretty clear that most government bureaucracies are pretty left-leaning. It would seem based on what we've been able to read and how like the FBI has behaved, for instance. I think that in the Fed itself is pretty woke if you look at some of the stuff that they do. So I think they lean to the left, and so now would they do something that was unfriendly just because they don't like Trump? I don't know. They might. They're certainly not going to be inclined to have him have the political outcome be a tiebreaker, which they might if they like the person that was in the office. I'm not saying that they actively think about that, but they are
Mhm.
human and they are prone to error. That's for sure.
Okay.
So I don't know for
I
sure.
guess the question I'm asking is, in recent history, right, post GFC, market starts to look a little wobbly. Fed rushes in, with QE or lower rates or whatever, right, to rescue everything. COVID added the fiscal side into that, which is, oh, things start to get rough. We'll just send checks directly to households. So if we get this market correction, do you think is due in 2025? Do you expect to see that same like swift rescue playbook, or do you think for any reasons we might want to talk about that they might say, the administration, the Republican-controlled Congress might have a different tune this time?
No, I think they'll try to ride the rescue if the markets get weak. The question is whether the bond market lets them. Kind of
Hmm.
depends on how much damage happens and how people feel about inflation, right? But
Yep.
if the bond market leaking is part of the process of taking the market down, which, could be part of it. If the market cracks and then bonds rally, and then the stocks crack some more, and then the Fed came in to cut, and then bonds started declining again. Well, that'd be kind of game over, right? That kind of tell you that the bond that what I had been fearing was happening. So
Yep.
it's kind of dicey. That's the reason why the Fed couldn't ride to the rescue in 22, because bonds were tanking, and eventually stocks got the memo and started tanking too. But the Fed couldn't cut because they were trapped by inflation.
Because inflation was so high, yeah.
Right now, but if they're trapped by the perceptions that their actions might trigger that, that's why they need economic weak. They need stock market or economic weakness to give them some cover to try to cut and ride to the rescue. But the question is, does the bond market behave? And we can't talk about that till we get there and see what the bond market does.
Yeah. This is super speculation, but do you think that not that the administration controls this stuff, but do you think that the new administration might want there to be a bit of a clearing event in 2025? Get rid of some of the excesses, lower the bar a little bit. Let me blame it on the old guy, the old administration, and
In the past, it was always suggested that that's what new administrations would do, right? I haven't had that really, I haven't heard people talk about that for maybe 10 or 15 years. I kind of have a hard time seeing Trump admit to himself that, hey, we got to take some pain here. Let's let the market tank and the stock market tank, and we'll be better off 2 or 3 years from now. I kind of, since he likes to tweet about things that go his way, I get in order for that to happen, he'd have to say, hey, look, we're going to tank the economy and the stock market because we need to fix this stuff, and it'll all be better in 2 or 3 years. Just trust me.
Hmm.
That's the tweet he'd have to make. You could picture how likely you think that's going to be.
All right. So, if someone's listening to this, Bill, and they're saying, okay, well, Bill doesn't have the rosiest of outlooks for this year. He thinks stocks are going to have some sort of big corrective event and that bonds aren't going to do well. They might briefly do okay once the stocks are tanking, but then they could go back to their leaking again. How are you looking at navigating this?
Well, I still got my exposure to precious metals and the mining sector. I have less than I had because I lightened up in the fall to some degree, but I still have a lot of exposure. My lightening up is way more than most people have, I'm sure. And then I have some individual rifle shots, individual securities that I think can do well in almost any kind of an economic environment. That doesn't mean they'd be immune to a drawdown in the stock market, but if stock market noise didn't count, they could grow them. They have a chance to grow through whatever kind of trouble that we have coming. And then I have I'm building up. I have some short exposure to try to offset those group of speculative securities I just discussed without talking about specifically. Mostly it's in the form of Apple right now, but I've got I might broaden that out to Russell or some other names. I haven't really done it yet because I wasn't sure how this was going to play out. But my idea would be to protect the non-precious metals exposure that I have with shorts, and even have more shorts. I might become aggressively short if it looked like things were starting to play out for a while. But at this juncture, I've not done that.
Okay, but this is notable because I've been interviewing you for a good while, Bill, and I always ask you, this similar question at the end. And you hadn't been short until relatively recently. I think the last time we talked, you were like, I'm just beginning to maybe nibble in on some shorts. Sounds like it is a more established position in your portfolio right now, but still not a huge one, it sounds like. It sounds like it's more of a hedge against your rifle shots.
Yep.
And obviously, when you come on this channel and tell me, "Hey, I'm going big on shorts," that's going to be big news for folks
Yeah,
too.
I don't really know. I mean, again, it's so hard to read the tape because of the passive noise, right? I was a little lucky in the break we had over the year end because I had bought some SPU puts, which I never do, but I got a buddy on Twitter that saw an opportunity and I put it on and it worked. I made a rifle shot trade on the short side that actually worked.
Right.
But
And it
I
was
don't
cheap, right? I remember
Yeah,
back then
I
it was
mean,
like the cheapest.
the puts on the December expiration for you could buy a couple of weeks down 1% and change for no money. So that's why I did it. It was too cheap. The price to play the hand was too cheap, uh, so to speak. But I don't really have any really great short ideas right now because I don't know what's going to work. Again, because we're still fighting the passive. My stock that I've been trading from the short side off and on and buying puts and losing has been Apple. Now I keep thinking one of these days they're going to announce the quarter and they're going to announce the same crappy numbers, even though they will have dragged them down during the course of the quarter. That's how they play the
Yep.
game. And the stock will open down a whole bunch. Everybody that thought that it can't go down and they got away with it for years, now all of a sudden get caught. And all at once it drops. One day it drops, and like after the report, it drops 15 or 20%. So that's kind of I'm short Apple and I've got puts lower, thinking that if they finally get punished for not growing for 2 years and this dopey valuation, that I'll get paid. But I don't have a lot of really good ideas because I can't figure out the personality of the market, so I don't really know how to position myself on the short side.
Got it. Yeah. Which why, if at some point in the future you go more aggressively short, that will be notable for that reason. Okay. The rifle shots, I'm not going to ask you specifically what those companies are, but are there traits that they share in common that you can talk
Well,
about?
yeah, like for instance, I have three small biotech companies. Obviously, a biotech company can do well just based on their science and proving their new products as they go
Right.
through trials, right? So that's pretty obvious. You don't need GDP growth necessarily for them to do well.
Yep.
And I have a couple other ideas like that that aren't biotech, that are small enough that can grow their businesses, and they have enough margin and a barrier to entry that they can do well even without the economy at large doing well. One of them is a company called Pure Cycle Technology. And it's not nearly as speculative as it was when I first got involved, because they're in the process of proving that their technology works. We'll know a lot more when they report this quarter. It's still speculative because they don't really have any revenues, and they're in the process of proving that they can run their facility as planned for a full quarter and not have any downtime, which is some of the things they've been plagued with since they've been trying to bring this new technology to market. But if they can recycle plastic at the margins that looks quite attainable, they got to open it upside on growth. Doesn't really matter what the world economy is doing, because they can put plants all around the world and they can grow right through it, and they got a barrier to entry and margins. So that I went into some detail because I'm talking about the nature of a business, the nature of biotech, the nature of certain businesses. You don't need a strong economy. Obviously, if you're a retailer, probably you need you need the consumer to do well, right? There's some businesses that are really dependent on the strength of GDP,
Mm-hmm.
but I've tried to pick ones that can do well with zero GDP growth.
Okay. And what's interesting to this is we're we're coming out of this era, or we've had this era, which I think you would say, if I understand you well, Bill, probably ending, of the passive era where you could just ride the wave. And a huge part of what's been driving that has been the giant mindless robot, right? These passive flows. Um, we may now indeed be entering a period where active investing may be the hallmark of, much more the hallmark of the successful investor going forward. And you're giving an example of that here, where you're kind of doing your own homework and saying, okay, look, these are some companies I think, given where I think things could go economically, these are companies that could buck that somewhat pessimistic economic outlook that you have.
But what's not clear to me is that there's enough active people working hard to really make these kinds of ideas work. I mean, I worry about the fact that if there's no active investors, how do you get things to work? Now, we both
But
know
like if you find the diamond in the rough, but nobody else does, it doesn't benefit,
it
right?
doesn't
Yeah.
do you any good, no matter how great your idea is, right? And so, guys like David Einhorn have tried to get around that issue by buying companies where the companies were, buying in their own shares or something like that. So where the company's taking control of the things that drive the stock price all by themselves. He's found handfuls of companies like that. So I'm not making the claim that active is making a comeback. I hope that it does. I think we'd be better off if it did. But some of these companies that I'm involved with don't really show that there's a whole lot of pulse in the active arena. Now, if they can be exciting enough and do well enough, then you'll force people to come find them, right? But if you take a look at the mining sector as an example, last year gold was up what, 25, 6, 7%. And I think the GDX was up maybe 12 or 13.
Yeah, yeah.
Now, there were a few companies in the sector that did really well. I was lucky enough to be involved with them, but they had unusual characteristics. Like they were in safe jurisdictions, they had high grade mines, they had ability to grow via their own drill bit and their own properties. They didn't need M&A. They weren't in a bad place. And so the ones that worked really well. But again, I think that's part of the problem that the mining sector has, is that there aren't very many active managers, and Americans don't seem to care about gold. I mean, over the last 2 years, I believe the tonnage for the ETF is down 20%. At the same time, rice is up 40%. Simon Mikhailovich made a post about that this morning. I think I saw it. I mean, it's generally true. The price of gold went up, and GLD liquidated assets last year, even though gold was up 25, 27%. So there's no enthusiasm. Now, if you got some enthusiasm in that sector, that would drive enough active people there that those stocks could work. But trying to make the case that those stocks are going to work has been a theory I've been making that hasn't really come true thus far.
Okay, but you're still maintaining your positions in both the metals and the mining stocks. You said you've
Yes. Yes.
you lightened up a little bit, but it sounds like it's still the healthiest percentage of your
Yeah,
long
no,
portfolio.
my exposure is still quite substantial. Yeah.
Okay. So I'm just curious, looking at last year's track record and saying, whoa, okay, well, miners didn't really pick up the way that we thought. What makes you optimistic enough about the space to still hold it as your largest position?
Well, because I still believe that gold is is the best way to express the fact that you don't have confidence in the world's central banks or the governments. Now, maybe our government's going to be better, but they've got a bad hand to play. And the propensity of the central banks to make errors that lead to inflation. All the currencies are no good. The US dollar is the king, but that's really the one-eyed man in the land of the blind when you look at the other currencies. So, I mean, I'd like the Japanese to start raising rates. I would buy yen if they call an election in Canada and Pierre Polivar, looks like he's to become the prime minister. I'd probably buy the Canadian dollar. But really, there's no you can. I'm a person. You can skinny around to the markets, but most of these currency markets aren't big enough for giant amounts of money. Obviously, the yen would be. So I got off on a tangent there, but um, I think gold is the best protection against bad policies. I believe it moves inversely to confidence. And I think there are reasons to have less confidence, although I think the Trump administration will garner more confidence than the prior one.
Mhm.
Um, so I want to keep my exposure. And the mining stocks that I have, I think are well positioned. They're not expensive. And so for me to sell them, I'd have to say, well, the idea hasn't worked and it's not going to work. But for me, it kind of has worked. It just hasn't worked as well as I would have hoped
You
it
thought
would.
it would, yeah.
So,
So
and I just don't think we're going to go through this entire bull market in gold without the public coming back to it. Maybe they
that's where I
won't.
was going. Okay,
I don't
so you
go.
think the Western investor will become more gold uh,
Yeah, yeah. Now
appreciative?
maybe so many people in America have decided they want to have Bitcoin instead. That's their choice. I can't believe that's really it. I think people have been so enamored with, well, we just buy tech, we buy the Mag 7, we buy all the stuff that all works with. Yeah, we heard you guys that have your negative story about this, that, and the other thing, but look, the spoos are still, the mighty, mighty spoos. And so we don't need gold. We don't need any of that stuff. So it may be that you need some sort of a problem in the market, like we've been talking about, that then triggers people to say, well, maybe I need to do something else because this is the thing that I had that was working isn't.
Right. Okay. So just because you mentioned it, Bitcoin had a pretty ferocious run into the end of 2024, cracked over $100,000 a coin. Um, yes, in the US, well, I mean, look, there's a certain amount of investors that believe in that and have now,
Yeah,
given it a
yeah.
multi-trillion
They
market cap.
believe in it the way I believe in gold.
Okay. What do you have any general thoughts on Bitcoin versus gold? And maybe a good question would be, if you believe that about, if those are the reasons why you own gold, do you own any Bitcoin in your portfolio?
I can't get comfortable enough owning Bitcoin. I analyzed it very carefully at $600 an ounce, or a coin, I mean, and I was smart enough to pass. Now it's $100,000. So, why would you want to know what my opinion is about that?
Okay.
My problem is if I own an ounce of gold or a brick of gold, I don't need anybody else to validate that, right? I don't need a network. I don't need, the reason gold works the way it works is because it's pretty obvious, it's very hard to counterfeit, right? If I'm going to walk around with a Bitcoin, first of all, I can't. It's not easy. You have to have a cold wallet or some form of storage. But then I need the network to be able to have it do anything. I need this whole infrastructure. And for me, I just have a hard time viewing it as something that can hold its value in any period when it's dependent on other things. So for me, I couldn't put a lot of money into it, but I already showed you how good my analysis was. I missed the move between $600 and $100,000 a coin. So, like I say, why would you want my opinion on that?
All right. Well, there are a lot of folks out there with stories like that, so you're not alone. All
Yes,
right.
but
Well, look,
I actively decided not to do it. I didn't just not know about it.
yeah. All right. So Bill, as always, fantastic. Just wrapping things up here. Is there anything about favorite assets or investing strategy, given the year you think that lies ahead, that we haven't talked about that you think are worth putting on folks'
No,
radar?
we've talked about a lot of things in front of a lot of upcoming known unknowns that are happening. So I don't know how we can go into much more detail until we start to see how things are going to play out.
All right. Well, Bill, as always, you will have an open invitation to come back on this channel at any point in time to make an audible when you have some more data that informs your outlook. In the meantime, for folks that have really enjoyed this conversation, where can they go to follow you and your work?
My website is fleckensteincapital.com. And my Twitter feed is at FleckCap. I don't post lots of things there. I mostly just, repost other people's things and but if I see something important, I yap about it. But I do most of my real work at my website.
All right. And it's a fantastic website. Highly recommend everybody go there. Bill, you've been writing that for what, since the early?
1996, the spring of 96.
Yeah.
I
All
didn't
right.
start my own website till '04. I wrote my column was originally on Silicon Investor and at MSN, and then it was at my friend Jim Grant's, and then it was at Real Money, and then in '04 I decided to start my own website and not have somebody else pay me to do the thing, and so I've had my own website since '04. So I've been writing for almost 28 years now. That's pretty crazy.
Yeah, well, it's fantastic, and the value in terms of the low cost per high insight from it is it's almost
You mean
unparalleled.
it's not overpriced at $10 a month?
Yeah, exactly. Not at all, not at all. Especially again for the generous amount of your insights that you
Uh,
share in it. So highly recommend folks go check that out. Folks, though, Bill, when I edit this, I'll put up the URLs to both your website and to your X handle, but also folks, I'll have links in the description below this video. Bill, it's been fantastic. Thanks so much, my friend.
yeah, thanks for the great questions, Adam. It's always fun.
All right, well, now's the time on the program we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money, to both react to what Bill Fleckenstein just said and also give us their update on what they're seeing happening in the markets here at the start of 2025. I'm joined as usual by lead partners John Lodra and Mike Preston. Hey guys, great to see you. Mike, why don't we start with you? What were some of your key takeaways from the discussion with Bill?
Hey, good to see you, Adam. As Bill talked about, he said the economy's not all that great, but not all that terrible. I think it pretty much sums up where we're at. Although I think we'd probably say that we might disagree a little bit on the fact that it is not all that terrible. It is pretty terrible, and that you have to keep inflating asset prices, or the whole shebang falls apart. That's a little bit of a terrible situation to be in, and that's what I think we're in. Um, this budget deficit is huge, as he talked about. That's helped our economy for so long, decades even. And it's really because of the world's reserve currency we've been able to do it, and our economic strength. But when is that gonna end? Nobody really knows. Bill talked also about the fact that the rest of the world really doesn't offer that much to be excited about. China's not the great growth story, it seems, that we may have thought it was a few years ago. And so the whole world's in a bit of a quagmire. Every central bank is kind of doing the printing scheme and propping things up from an asset price perspective. But how long can these obscene valuations stay? Valuations are easily triple what they can reliably be from a long-term historical perspective. Is this time really that different? Are we really have we found a new paradigm or a fountain of youth? I don't think so. I don't think Bill really thinks that either. And he says that we really can't inflate our way out of this without tanking the bond market. And the bond market is saying, we're not going to allow this. The bond vigilantes have started to come back. I don't really think that we can say that they're back in force, but the market has raised rates on the long end. And I'll share a chart in just a minute to show you what that looks like. And we'll be the first to admit that a 10-year yield close to 10%, which is where we're at 4.7 right now, is not historically out of the norm, but the speed in which it went there from a near zero condition is out of the norm. And for an economy that has 30 something trillion in debt, going up 36 trillion in debt, I think roughly the latest numbers, going up by 3 trillion a year, it really can't handle that for too long, in our opinion. And so we can't inflate our way out of this problem without tanking the bond market. And the bond market is starting to say, hey, wait a minute, we're going to move long-term interest rates higher. And Bill talked about this mindless robot, this passive investing stuff. This is not going to last forever. He called it passive lunacy. The real tough part about all of this is we just don't know when it's going to end. It's been going on for years. And as money managers, we're trying to make a little return, fair return for our clients without taking on much risk. We really don't want to give up a lot on the turn. And now everyone's out there saying that, oh, you can sell the top and just wait for the bottom to happen. It doesn't work like that in real life. The top is a process. It's somewhat stealthy usually. Sometimes it's a crash. And we think we're at valuations that are screaming warnings here. And yet, this market's gone on and posted a big 20+% return in 2024. And, we'll see what it does in 2025. Our best guess is we're getting close to the end of this cycle. Lastly, Bill talked about a few things that we agree with, like precious metals and mining. He talked about taking some profits in mining stocks. We also rebalanced in mining stocks a few months ago on a swing higher. We still have a position in metals and mining. We've actually replaced some of our mining stocks with metal bullion itself because of its relative strength position over and above the miners. So I mentioned a chart. Why don't I share it quickly, and then I'll pause from there. This is a chart of TNX, which is the 10-year yield. And this column right here is 2024. So during 2024, the range was between 3.6 and about 4.6. In 2023, in the fall, we reached a high of 5% on the 10-year yield, and we went all the way down to 3.6. Right now, we're up in the high 4.6 to 4.7 range, and there's nothing to say we can't go higher, even higher than 5. But my best guess here is that we might be reaching levels there that would slow down this rise. So what we don't know is this just a counter trend rally and that we drop more from here? We think probably we will drop quite a bit lower in the coming years if we have an asset price drop. And I think that even Bill said something like that. He said that bonds will be leaky until stocks start to crack. Well, it's probably true. Stocks crack in a big way. I think the Fed drops rates on the front end and the bond market probably drops rates on the long end. So that's the yield. Taking a quick look here at the price of TLT, for instance, which is an ETF that owns long-term bonds. We reached a swing high of 100 and then we rolled over, and now we're plumbing the lows again. There's support down here at the 85 level, but this has been a hard trade to stay in. We have a small position in long-term bonds, about 7 to 7.5%. We think that long-term bonds will go higher and that yields will go lower, but we're not making a big bet on that. That's the key. A lot of people fret about this long-term bonds, but we're not making a big call. And frankly, we think there's a good trade to be had in the next year or two, but it's just a trade. And then lastly, a quick look at the yield curve. The yield curve now is the blue line. The yield curve a year ago is the red line. So we were inverted for years. The longest time since I think the 70s that the yield curve was inverted for as long as it was inverted. Now the yield curve is uninverted. Take a look at the blue line. T-bills are around 4.2 on the short end, 5% on the long end, 20, 30-year bonds. That's a bad sign historically, but the yield curve is uninverted. The bond market, as I said, basically cried foul and rose rate increased rates themselves. This is a normalization. Can yields go higher on the long end? Absolutely. But our view is we're probably getting to a level where they're starting to reach resistance and might be topping out. So I'll take a pause there.
Okay, a lot of questions coming out of that. One is on the TLT trade, which we've mentioned on this channel many times over the past year plus. Has kind of been a painful trade of late. Looks like you think, from your perspective, it's a trade you guys are still staying in, so you haven't given up on it. If bonds continue to leak and TLT gets really down to that support level that you showed, would you guys at New Harbor actually increase your position at that point in time?
We might, Adam. We're sensitive to the fact that, as I said earlier, rates up at 4.7 on the 10-year is not historically that out of the norm. We could go to 6 or 7. I don't think it's going to happen. I really don't. That would absolutely crash the economy, in my opinion. I personally think, and there's a lot of debate about this. Nobody knows who's right and who's wrong. Personally think that rates are probably topping here and will roll over and head back into the 3s in the next couple of quarters. But if we popped above 5 and the TLT went to the low 80s, we might nibble. We would never take a big position. We would probably nibble at another 2.5% back to 10%, maybe 12.5%, something like that. I don't think we would ever get to a point where we want it to be 20 or 30% there. There's no need to do that. There's a lot, particularly with on the short end rates, offering in the 4s still. There's not a lot of reason to take big risk, and everything we do with humility and with risk control in mind. So we would probably nibble, but not take a big stake.
Okay, and one of the reasons why I ask is if Bill Fleckenstein's, outlook proves correct, where bonds leak, which means prices go down, but yields go up. Bonds get cheaper in price, and nobody can time this perfectly, but if bonds leak until the market breaks, as Bill thinks will happen, and you get the response that you and Bill think we will, which is that the Fed will then come in and cut aggressively on the front end of the curve, and then bond investors will take the long end of the curve down as you get sort of the safety trade coming in. You kind of get the best of both worlds in the long bond trade under those conditions, right? Where you lock in a higher yield that you'll get paid as all the other rates are coming down on a relative basis, and you're going to get the price appreciation as that happens too, right?
Absolutely, and I think it's a great trade over the next 2 years. Long term, we certainly have concerns about what the Fed's reaction would be to an asset price crash. They'll probably print another 10 or 20 trillion dollars. That'll create inflation and maybe tank the bond market. But between now and then, like between now and 2 years from now, there could be a great trade, and we think there likely would be in long-term bonds. TLT could easily go back to, let's say, 120 if rates went down to 3% or so. That's a big gain on top of the current yields you're getting. But you got to be careful in investing, never to bring yourself to the uncle point.
Mm-hmm.
If you might be right, but you don't really want to feel the stress of having to get out of that position. We actually adjusted the position down from 10 to 7.5% when we broke through support at 95. And so what would bring us down from 7.5 to lower? At this point, probably not much. We're not talking about an individual tech stock here. We're talking about the entire US bond market. And after all, we're getting paid almost 5% while we're sitting waiting. But what would it cost us to increase it? Yeah, maybe we would increase some on a drop to the low 80s in TLT. And yes, we would expect there to be a big bounce in the next year or two, but never bring yourself to the uncle point where you feel that kind of stress. It doesn't.
Right, where you get kind of forced out before your thesis is proven correct.
Exactly.
Okay. All right, John, thanks for being patient. Coming to you. I know you've got some additional thoughts, I think, about yields, correct?
Yeah, I'll just offer a little context for maybe what's been powering this sell-off in bonds. A lot of speculation, a lot of theories about it, but let's just look at some data. And then I'd like to just quickly pick up the baton from Mike there on valuations and hopefully bring that back to what we think are key ramifications for our clients and investors that are real serious about their financial stability. So let me share my screen here. So a lot of debates as to what's been driving this sell-off in bonds. I think it's pretty clear that markets, foreign central banks, markets in general are worried about U.S. fiscal deficits, which have been off the charts. I think the market is hopeful that the Doji agency can do some wondrous things there. I think Bill Fleckenstein thought 500 or 600 billion would be a miraculous achievement, far short of the 2 trillion. We don't have a very strong view on that, but it's a tall ask, but one that we all as taxpayers should be, hopeful that we can cut some waste out of government. But here's a couple of charts here. The top pane is basically the 5-year break-even inflation rate. This is the imputed market expectation for inflation over the next 5 years. And you can see right around when the Fed started cutting short-term rates, September 18th of 2024, this has shot up, and even more recently, we've seen it curl up there. Yesterday, we had yesterday or the day before, I forget when it was, ISM services prices paid number, really spooked the market on inflation. So there is this resurging fear about inflation, certainly by the market and some of the Fed comments as well. The other factor here is what's known as a term premium. It's a little bit of an academic thing, but it's basically the premium that investors should be commanding for longer term bonds relative to just simply rolling shorter term treasuries. And in the distortion of the bond market, for much of the last decade, this term premium has been very low and in fact got quite negative. But we have shot up rather dramatically here. But if you look at where the average of that it was probably before the GFC, we're talking about 1.25, 1.5 or so. Right now it's about 0.7. So we theoretically have another 0.5% to 0.75% in just term premium rises in interest rates, just to reflect the risk appetite of investors. So not a prediction that happens, but it just opens the mind up a little bit. We think that the sell-off in bonds has been extreme, and it has, but we need to kind of set some expectations for, yes, it can get more extreme. It's not that far out of whack with what is possible. And then I'll just put this chart together. This is a chart that just shows, one of the comments that we often hear is that, well, geez, if rates go any higher than where they are now, the government budget is just going to crumble. And this just puts a little bit of cold water on that, in the sense that this is the percentage of interest payments by the government as a percent of tax receipts and as of GDP. And you can see it's gotten pretty extreme here in recent times, but it's still not where we were in the 80s and mid to late 80s. Now, these are different environments for sure. I mean, we had a fraction of the total debt in the 80s and mid to late 80s than we do now. And this was a undebatably growing economy with valuations that were fairly reasonable for stocks versus a economy that's very late cycle and valuations that are very extreme. So I'll pause there, but I do have some other comments on the valuations that I'd like to touch upon.
Okay. Well, look, why don't we get to them right straight? One question I regret not asking Bill was about, he says the bond yield basically is sending warning signs here that, hey, we're not super comfortable with where things are headed. But if you look at credit spreads, they're still very tight, very, very tight on a relative basis. And as many of the experts, including you guys who appear on this channel, have said, that's really going to be your tell that the bond market is getting really worried, is when credit spreads start blowing out. So that's kind of an anomaly in the soup right now, where we see these other signs of warning, but the key indicator is telling us everything's still fine. But related to that, so kind of what I took from you and Mike's comments there about bonds is, yes, yields are high. Yes, bond prices have moved down pretty rapidly, and we should take note of that. But we're not at like a historic extreme, right? You're shaking your head as I'm saying this.
And I think we think the extreme was the absolute distortive intervention by the Fed and other central banks.
Right. Yeah,
that was the extreme. We're now
that was the
getting some
extreme.
normalcy, right?
Yeah, we're normalizing, as Jerome Powell would say. But if you look at stocks, almost every indicator you look at, they seem to be at an extreme. And one bit of data I saw today, I don't have the chart digitally, but I'm looking at it right now here on a piece of paper. While credit spreads are tight comparing corporate debt to government debt, if you compare the spread between the S&P 500 earnings yield and corporate bonds, it's actually negative, which it rarely is. It really shouldn't be, because stocks are riskier, right? And so you would want to be getting a higher earnings yield off your stocks than you are that bond investors are demanding off the debt. But that relationship is inverted right now, which is another sign that stocks are really richly priced right now. You're not, as I'm saying this, John, but let me hand the football back to you to pick up on that.
Yeah, and I just want to make one more point. And Mike made this point, but I'll just emphasize it. Our response to where the bond market is it's all about position size. We have had a very modest position, and one that we have tactically reduced. So much of this downdraft in the bond market has been relatively benign for our clients, because we've been very, very overweight. Just to put it into context, we have about 34%, 34.5% in short-term treasuries, a year and a half or less. And only about 7 to 7.5% in longer term treasuries. So our emphasis certainly has been on the short end of the curve. But yeah, let me share a chart, because this I think in one page says a lot about where we are. So this is an article that came out on Market Watch just a couple days ago, I guess. And basically, it's a Fed official, Federal Reserve Governor Lisa Cook, basically, talking pretty bluntly about valuations. And she says valuations are elevated in a number of asset classes, equity and corporate debt markets, so on and so forth. When you start to see Fed folks talk like this out there, it's typically a signal that they are boxed in. They are boxed in policy wise. You bet every central bank would rather lower rates than raise rates, right? And suddenly the menu has gotten very complicated. The market's only pricing in one rate cut for all of next year, even though the Fed has said we think two, and that's down from four when they first started cutting rates in September. So this says volumes, I think, and speaks to the dilemma that the Fed is now facing with this kind of riot in the bond market, if you will. But let's focus on valuations. This upper one is a chart that we'll keep sharing because it's black and white data. This is one that John Husman puts together. It's in his latest commentary that just came out. And it's statistically, it's the most robust indicator if you go back over all history in terms of what the subsequent likely returns will be over the next 12 years. There's one ironclad rule that I have seen no one refute, is that there is a tight relationship between returns over a decade, for example, and the starting valuation. Valuations do very horribly at predicting returns over, say, the next year, but they are very, very robust in predicting returns for the following decade. This indicator is amongst of all the work we've seen and all the work John Husman's done, the most statistically correlated with subsequent returns. And based upon that work, you get this scatter chart. Basically, every one of these dots is a correlation of these points on this valuation curve with the actual 12-year subsequent returns. This data series would suggest that we have negative 6% returns over the next 12 years. Sounds absurd, and it kind of is, but that's what you get from absurd valuations. But
yeah, and I just want to point out, John, that the data point there is the most extreme outlier in that entire data set. So when we talk about being at extremes, we're not talking about like, oh, a kind of extreme. We're like the most extreme.
Yep. And even if we take Wall Street's favorite valuation metric, which is simply forward PE, which is rife with its own problems as a result, isn't as robust of an indicator of forward returns. And this is a chart put together by JP Morgan Asset Management. We're right here, okay? Anytime this in history, and this goes back to 1988, I think, anytime we've been here, you can see the range of returns has been about -2 to +2% over the next decade. Those are annual returns over the next decade. So even kind of the more genteel kind of looks at valuation would translate to very disappointing returns over the next decade. Again, says nothing about the next month. We can talk about the short-term action, which has us starting to get pretty concerned. But these are big takeaways that at the end of the day should be really concerning for clients. And this is just a simple, like, kind of cash flow scenario of real life scenarios of taking a nest egg. And if you had invested that nest egg $1 million at the low valuations of 82 and then withdrew some money at 5% a year adjusted for inflation, not only could you successfully pay those needs, but the ending value would continue of your portfolio would continue to grow. Change that and just simply take the timing that you retired in 2000 at a Shiller PE ratio of 42.18. You get these big negative returns. By the way, negative returns like this aren't random. They happen when valuations are extreme. There is a correlation there, a high correlation. But the timing, the sequence of returns driven by valuation multiples it could be devastating. The same kind of spending profile, this portfolio nest egg gets negative by the end of the 15-year period. This is where we really got to bring these valuation things not from an academic exercise, but back to, can our clients support the lifestyle that they have worked so hard to afford for the rest of their lives? And that's really where the rubber meets the road for us.
I'm really glad you just showed that table, John. In general, people aren't great about understanding probability and whatnot. And for a lot of people, once the mental math gets beyond a certain level, they just, they kind of make broad-based assumptions. This is why financial planning is so important, right? Is you just get the hard numbers there on the table and you start doing the scenario planning, right? And in your point there, just a little bit of timing differences in terms of where the losses are taken can make all the difference in the world in terms of how much money you end up with or, God forbid, run out of during the time where you're depending on it. Do me a favor if you can, John, just pull up that chart again with Husman's scatter plot on it. And then we'll start wrapping things up here. But folks, imagine, so I live out in California, and there's earthquake risk out here. But the incident rate and the probability of a big earthquake is very low on any given day, if you will. So to be honest, you live out here in California, you kind of forget about the earthquake risk. You focus much more on fire risk, like we're seeing in Southern California right now, or flooding right now during the winter season up where I live. Um, and so what you got to do is your own assessment of like, well, how worried should I be about an earthquake? And most people aren't that worried. If they have to and can get it, though, they might get earthquake insurance for their home. But a lot of people, if they can, they try to go without. So imagine if that blue dot plot there, all those dots were the probability that a big earthquake was going to happen where you live. Now, if you were, on the left tail of that distribution, you would say, I don't need to worry about it. It's such an unbelievably low probability. I'm going to spend my time focusing on many other things, right? But if you were the dot that we are right now in terms of negative returns, the most extreme dot on that, with the highest probability of an earthquake happening, you would, as you move towards that, you're going to start saying, all right, look, the probability is going up. Yeah, maybe I will make sure I call the insurance company and get earthquake insurance if I don't have it. If it was where it is right now, the most extreme, highest likelihood probability, you'd probably say, geez, maybe I should move, right? Like, you would take personal action if that was something like an earthquake risk in your life. So I think you need to look at this from a financial earthquake standpoint of like, look, given that the data set is telling us that we have the highest degree of likelihood to have the worst decade performance ahead of us, probably doing nothing is irresponsible. At a minimum, you should sit down with a financial advisor and run some numbers and maybe ask some questions about, hey, if some event were to happen, how protected am I right now? Maybe I should move some of my position to cash, or maybe I should put some hedges in, or whatever. But don't sleepwalk into this future with probabilities being this far as they are on the distribution curve.
And that's a great point. I wonder if I could take the liberty. This is really timely because I had a very simple discussion with a client about this as relates to the bond market and the stock market. And if you'll indulge me, I'd like to just share a simple kind of analysis.
Go for it.
That client. This is just simple hypothetical. This is not meant to be a forecast or anything like that. But I've looked at TLT, for example, talk about the bond market. And when I was doing this, the current price was 85.5, let's call it. And let's say we got two scenarios: price drops, price rises. And let's say that if we look at where the previous low on TLT in October of 23 that Mike referred to, it was right around 83. So let's say, given the trends and the momentum in interest rates, that we think there's a higher probability that rates go higher first than going lower, and we put that at 65%. And we talk about a price and that would bring it to 83 if we shot 83 area, if we shot back to 5% or so. That's a negative 3% return, from where the current price is. Weighted by the probability, that's a negative 2%. Now, let's say there's a 35% chance we go up and retest the recent highs in TLT. That would be nearly a 10% positive return. On a weighted return basis, you sum up these two weighted returns, it's actually a positive expected return. But you need to kind of account for the scenarios, right? And then here's where position size is important. If there's a higher probability that we decline, it's really the question is how much a position can you handle if it does decline in that scenario, right? So this is the challenge of investing in a nutshell, in our opinion. It's probabilities and the asymmetry of the outcomes. Higher probability of a certain move, might be dwarfed by a lower probability, but a much bigger move. And that is not an easy task for anybody to do. And but it is the key central challenge, in our opinion, of what is on the table.
All right. Well, super useful. And again, great illustration of the type of discussions that people should be having with their financial advisors. Don't just go with your gut. Just don't go with, headlines or what some macro guy says on a channel like this. Actually run the numbers, find out what the expected value math is, and then, make a very informed decision based off of that. All right, John and Mike, we got to wrap it up here, but great session today. Happy New Year. Looking forward to a great 2025 with you guys. both appearing weekly on this channel, as well as some of the live events that we're going to be doing on both the Thoughtful Money side and on the New Harbor side together this year. Folks, if you've enjoyed the discussion with Bill Fleckenstein, would like to see him come back on again soon when he's got an update to his outlook. Please let us know that by hitting the like button and then clicking on the subscribe button below, as well as that bell icon right next to it. And obviously, if you would like some help in preparing your portfolio, your overall wealth strategy for 2025, now that we're right here at the beginning of the year, then recommend that you do that under the guidance of a good professional financial advisor, but one that takes into account all the issues that we talked about with Bill and that John and Mike and I have talked about here. If you don't have a good one to do that with, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me here on this channel week after week. Perhaps you might even want to talk to John and Mike themselves there and their team there at New Harbor Financial. So to set up one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds to fill out. These sessions are totally free. There's no commitment to work with these firms. It's just a free public service they offer to be as helpful to as many people as possible. By the way, when you're there at thoughtfulmoney.com, don't forget to hit the newsletter link at the top of the website to sign up for our free newsletter. And with that, John and Mike, thanks so much again, guys. Great week. Look forward to seeing you next week.
Thank you, Adam. Happy New Year to you and your viewers. We'll see you next week.
Thanks, Adam. We'll see you again next week. Appreciate it.
All right, everybody else, thanks so much for watching.